Weiner from a company called Monetary Metals, and I want to talk about transparency in the gold market. That's it. Anybody have any questions? Just doing a little check here. By show of hands, who thinks the gold market is transparent right now? Is there anybody who thinks that? There's a lack of information and a lack of understanding, and there's also a genuine lack of transparency is a real problem. And so I figured I would talk a little bit about how it works and add a little bit of information, and then talk about a project that I've been involved in to bring some data to the public that increases transparency in this market. So I want to talk about how a futures market works, and I want to talk about the gold forward rate. Gold forward rate is a number that is of keen importance to everybody in this industry. Miners, refiners, mints, jewelers, everybody who's doing anything with gold should care about, or does care about, and depends on, their business depends on the gold forward rate, which the London Bullion Market Association used to quote from at least the 1980s through 2015. So I'm going to take a step back here for a moment and talk about a futures market using the analogy of a agricultural commodity. And you might wonder, so that's Farmville and that's Gotham City. How does the wheat get from Farmville to Gotham City? And the answer is there's a spread in price that attracts the entrepreneur. It says, oh, geez, I can get a truck, I can go to Farmville, I can load up, I can bring it to the city. I pay one price in Farmville, I sell it for another price in the city, and I can make money doing that. And so the next entrepreneur comes in, becomes a little more competitive. The next entrepreneur enters and so forth until the marginal entrepreneur, that's the guy who looks at it and says, can't make any money in this business anymore. Got to find something else to do. It isn't worth it for a penny, a bushel, or whatever the spread might end up being. This is a crucial concept, two crucial concepts here. One is spread, the difference between you're buying in one place and selling in another. And the concept that spread tends to come in when coordination is improving, but only comes into a certain point until the marginal entrepreneur, the marginal guy looks at it and says, this spread is too tight, I can't make any money here. Those are two key concepts for economics and markets as I look at it. So one of the problems you have here in an agricultural commodity is, what do you do in autumn? How is wheat supposed to come to the city? People eat bread all year round, but the harvest is really only in the summer. So what now? And so obviously the answer is we have grain silos. We store the grain so that we can pull it out of storage and consume it at times when it isn't being harvested. But I want to ask a question that doesn't tend to get asked very often. How does this work? I mean, if you're saying that the guy who operates this silo, or we'll call it more generically a warehouse, if he's supposed to buy the grain in the harvest time, which is July or August, and then wait until January or February to sell it, we're asking him to be a speculator on price. That's not really a business model that's sustainable. I mean, if 1 year the price goes down, this guy could be out of business, and creditors will seize the business. So the guy operating the warehouse doesn't want to be the price speculator. He wants to simply operate on a predictable spread and know that that spread will cover the cost of his capital that requires upkeep and cleaning and so forth, plus enough profit to be worth the whole thing. And so this is where a futures market comes in. And so the futures market enables these three characters, who I call Farmer Frank, Silo Steve, and Baker Bob, to coordinate their activities. The farmer needs to sell. He needs to sell the whole crop. He needs to sell the whole crop when it comes off the fields. If he lets it sit there, it rots. And not only does he have the problem of destruction of his entire year's income right there in the fields, but in addition, even if he could somehow keep it dry, he needs the cash. He's got to pay his loans. He's got to pay his people. He needs to liquidate. when that harvest comes in July or August. The baker needs a reliable source of wheat all year round, and the silo operator needs a predictable spread that he can make a profit on. And so these three characters come together in a futures market, and the way this works is Silo Steve is buying in the spot market, so he pays a certain price. He's immediately selling it forward to Baker Bob. Right there in August, Baker Bob is going to say, I want a September contract, I want an October contract, November, December, January, all the way throughout the year. So he's locked in a predictable supply, so he knows what it's going to cost him to bake bread. Silo Steve locks in his profit, Baker Bob locks in his key ingredient, the farmer sells his wheat, everybody wins. This is why a futures market evolved and developed in the first place. So that spread, future price minus spot price, if you annualize that in any commodities market, that's called the basis. That's probably the single most important number in the market. And if so, going back to the, I think this will reverse, yeah. So I use this example over here to show how the entrepreneur is helping coordinate activities over distance, over space. The futures market is helping coordinate activities over time. That there's a future, there's not a distance of transport involved, there's a distance of time involved. Does that make sense to everybody before I proceed? This is like a crucial concept. Now, so I love this Jackie Chan meme. You see it on Facebook all the time. It should be noted that there would never be in a free market a futures market in gold. I mean, gold is not an agricultural commodity. It's not subject to weather risk. It's not produced seasonally. It's not consumed. Virtually all of the gold ever mined in thousands of years of human history is still in human hands. So there's no real point to a futures market, but we have a fiat currency, and so gold is treated as a commodity. In a free market, of course, there's not a futures market in gold, there's a bond market, otherwise known as an interest rate market. But the futures market is sort of what we have as a surrogate for that. And in the gold market, the bullion banks are acting as the warehousemen. That is what the bullion banks, that's the function that they perform. They're buying gold in the spot market and selling it forward and making a spread. Talk a little bit more about that. So I found this, I didn't realize there was a book called One Hand Clapping, but there's always this debate raging in the gold community, where is the price set? And so I said, okay, if you're clapping, which hand is making the clapping sound? It takes two to set price. There's this connection between the two markets. This concept, I'm going to talk more about what the banks are doing. They're making a little bit more than the basis spread, which I'll talk about in a minute. There's so much BS, pardon my French here, on tape that is said about this market and what the banks are doing. The banks are buying spot and selling forward, and they're making a small spread. And this relates to the gold industry in a moment. If you understand that, you can cut through so much of it to understand what's actually happening in the market. So there used to be, as I said earlier, this gold forward rate. And this is how the London Bullion Market Association, this is a quote taken from their old website, the rate at which contributors are prepared to lend gold to each other on a swap basis. So what that means is one party has dollars, that party is giving up the ability to get interest on those dollars by lending them. The other party has gold. They swap with an agreed time or maturity to unswap at the end. That's GOFO is the rate that is charged for that service. You could also think of it as the dollar interest rate minus the gold lease rate. And you can also think of it as the spread between the spot market and the futures market. That's what GOFO really is. You cut through all of this turgid prose. People read this stuff, and I don't think anybody really understands it. And one wonders if the LBMA wrote it so that very few people would understand it. It's like it's written for insiders, I think. So now I want to talk about something a little closer to the gold industry. If you go to a bullion bank, you want to lease gold. And so mining companies can do that to finance a project. Obviously, refiners and jewelers have working inventory, and they go lease gold. Where does the bullion bank actually get the gold? So there are two traditional sources of gold for these banks. One is some of them get it from the central bank of their respective country. But I think that's a downward trend. I think there's a worldwide political movement for people to pressure their national central banks not to be in the gold business. You see it here in the US. In Germany, I think it's more advanced. There's a repatriate our gold movement in Germany. So I think that's a trend that's in decline. Number two, these banks traditionally have attracted unallocated bullion deposits. So if you want to own gold or at least gold price exposure, and you don't want to pay storage, and you have a couple of $1 million, then you just go to JP Morgan or HSBC and you have a unallocated gold deposit. But I have to think that trend is also in decline. If anybody's reading anything on the internet, I'd have to think they'd be pretty scared to trust a bank with gold. It kind of defeats the whole point. Gold avoids the counterparty risk. So why would you hold gold as a counterparty liability? So I think both of these trends are in decline, which means what the banks actually have to do, and you come and say, I want to lease, the bank has to borrow cash and pay interest on that. These are all simultaneous, by the way. This is a four-pronged or four-legged arbitrage. Number one, borrow the cash. Number two, buy the gold in the spot market. They physically buy physical bars. Number three, they lease it to you because you came and you wanted a lease. And four, they sell the gold forward. So let's say it's a 1-year lease. You buy the gold. You borrow a 1-year loan today. You buy the gold. You sell a 1-year future, and you sign a 1-year lease. So everything's all matched up, and the bank is making a little bit of a spread to do this trade. This, of course, describes GOFO. This is where GOFO comes in. And so borrowing is a cost. That's a negative. The basis is a profit. And so that's how you understand what the bank is actually making on this deal. It's not a high margin business. This is a low margin business for the banks. And I think generally inside the bank, the trading desk that's dealing with this is a very small group within a very, very large institution. I think these groups tend to be 10, 20 people inside organizations that have 100 or a couple 100,000 employees. This is not where JP Morgan and HSBC focus their time and effort and employee resources, for sure. So, suppose this is a picture of a hedge, my attempt at humor here. Suppose, and this is where GOFO really becomes a very practical thing for a gold mining company. Suppose a gold mining company wants to sell its production forward, which you call a hedge. Now, that can be done irresponsibly, as Barrick did in the 1990s. And then when they wanted to buy their hedge back after the price was really running up, it was in 2010, I think, they lost more money buying their hedge book back than they had ever made since inception. So prompting me to write a couple of papers called Hedging and the Gold Miners, Sell Low and Buy High. But suppose you were hedging in a more responsible way. What do you want to do? Well, you want to sell the gold forward. Everybody knows you've got a mine. The mine is producing X amount of ounces per month. So you have the credit to sell it forward. You're going to get the spot price plus some premium because you're selling in the future. That premium is GOFO. So taking numbers from last week, spot price was about $12.70, give or take rounding error. GOFO, as we calculated it, was about 1.44%. So you should expect to get $1,286 and change if you sold forward a year. So everybody needs to understand this rate if you're in this business. But unfortunately, and I say this unfortunately, the banks were accused of rigging and manipulating GOFO as they were. Is everybody familiar with the LIBOR scandal? So London Interbank Offered Rate is what that stands for. And this is like an old gentleman's club in London, where the bankers sit around and they're like, well, what do I think the rate is today, So in the case of LIBOR, it was worth it. It was worth their while to become compliant and build a transparent process because everything in the whole world practically revolves around LIBOR. They came under the same accusations for GOFO, and so the banks basically said, okay, you win. We're done. It isn't worth it to us. We're providing this as a public service. You're going to make this difficult and expensive. And so a lot of the folks which were very pro-gold that were going after the banks for some of the shenanigans that may or may not have been going on, you got to be careful what you wish for because you might actually get it. So in January 2015, the banks stopped publishing this. This is my analogy to basically for all the users of gold and all the producers of gold, it's like you turned out the lights. Now everybody's stuck in a dark room. How do you know what's going on in the market? There is, as economists would use the term, information asymmetry. So if you need to do a transaction in gold, you call your friendly bullion banker and he'll be happy to give you a great deal, my old friend. But you don't have any reference as to whether that's good or bad. I liken this to, suppose you're running a business and you need a credit line. You don't go to Bank A and say, what's your rate today? And the bank says 3%, and go to Bank B and they say 3.25%, and Bank C says 3.5%. You don't know whether that's a teaser rate. You don't know what that reference is. You go to three banks, and one of them is going to say, we'll lend to you at LIBOR plus 100. Another one's going to say LIBOR plus 125, or it might be Prime. It might be Prime as published in the Wall Street Journal, Prime plus 500 or whatever it is for a small business. But you're getting reference spread. And so now you know that if, of course, the market rate is going to move tomorrow and next year, but at least you know, okay, my rate moves with the market at this spread, and I can comparison shop, three banks based on that. That's what the gold world needs and currently doesn't have. So this GOFO number is really important. They stopped publishing it, and everybody looked at it and said, can we replicate this? And so I'm not picking on James Turk, who I count as a friend of mine. A lot of people said the same thing. There's no way to do it. I mean, in theory, you can use the futures market data and somehow come up with some formula to do it, but in practice, it really can't be done. And, anyways, using some unconventional techniques, that's what we Monetary Metals have done. This has been ongoing work of mine for many years, finally literally launching this week. So that's a chart of the LBMA GOFO for all the years it's quoted where we have overlap. From 1996 through 2015 is the blue line, and the red line shows our calculated GOFO rate, which has about a 0.99 correlation. This is on our website. We're offering this for free to the industry because we think this is so important that everybody needs to be able to see this as a reference. It's a travesty that it isn't there. Speaking of manipulation, I want to circle one part of the graph. This is you could call this the early run-up to the crisis of 2008. This lasted for about a year, where the blue GOFO line looks like the banks were trying to hold a plateau. They're trying to hold a line. And either they were in denial of something, or the spreads had to widen because they were internally having a liquidity crisis, or if you wanted to look for manipulation, this would be a really good area to look at. I would bet an ounce of fine gold against a soggy dollar bill that our calculated red line is the more accurate one. And you can see that the official quoted one finally collapses down and converges with the trend that we had been plotting for a year before that they finally did that. There's actually a bid rate and an offer rate, and that's really important to be aware of. The LBMA never quoted bid or offer, and it wasn't even really that clear unless you really read into it and understood it, which one they were quoting. But when we chart this, we show bid and offer. And it's important because if you want to sell forward, you're going to get the bid rate. And sometimes the bid rate may be a very unattractive rate. But if you want to buy forward, let's say you're closing that hedge book, you're going to pay the higher offer rate. Finally, you can see the effect of interest rates where they started to rise. GOFO is generally, although there's some exceptions and some reasons for it not to, generally going to track interest rates. The lease rate is LIBOR minus GOFO, and so this is sort of an inverted chart involving an interest rate now. So if you go to the bank and say, I've got a bar of gold, I want to lease it to you, you get the lower bid rate. That could easily be negative. Now, why would that be negative? The bank has no real use for that gold. The market is telling the bank that there's not really a lot of demand for it. They might have to store it for you, so they're going to charge you storage and insurance and a profit. But if you go to the bank and you need gold, you need to pay the offer rate. And that will never, ever in real life be negative. We have a calculated theoretical rate here that, first of all, assumes the marginal entrepreneur goes for zero spread, number one, and number two, doesn't include some of the other logistical costs and so forth. But it's interesting to see the graph of both of them and how that spread widens and narrows. So this data, as I said, is available for free on our website. I'm reachable. It's my email address. All right, well, thank you.